Crypto markets plunge. Bitcoin dips below key levels. On February 5, 2026, the cryptocurrency market saw a sharp sell-off, with Bitcoin dropping below the psychologically important $70,000 mark and other major tokens like Ethereum, Ether, and XRP declining sharply. Bitcoin's price fell roughly 7 to 10% in a single session, reaching lows not seen since late 2025 and marking one of the most significant downward moves since its all-time highs in October 2025. Bitcoin slipped below $70,000, trading around the mid-$60,000s during the worst of the move, down nearly 45 to 47% from its October 2025 all-time high of roughly $126,000. Ethereum, ETH, also recorded substantial declines, sliding by approximately 7 to 9% in the same timeframe. XRP, among the hardest hit, with falls exceeding 14 to 17% as traders exited positions amid heightened volatility. This sell-off extended beyond cryptocurrencies and mirrored weakness in broader risk assets, especially tech stocks. Major equity indices like the Nasdaq Composite, heavy in growth and AI-linked stocks, slid more than 1% over consecutive days, amplifying risk-off sentiment in digital assets. What's behind the downturn? Macro and market forces. 1. Rotation out of risk assets. Investors have increasingly moved capital away from speculative assets like cryptocurrencies toward traditional safe haven assets, including gold and treasury securities, as risk appetite faded. This rotation follows broader concerns about economic data, tech valuations, and uncertain interest rate paths. 2. Tech sell-off and AI narrative cooling. The recent sell-off in AI-linked tech shares weighed on the market. Much of the crypto rally in late 2024 and 2025 was tied to risk-on flows and the narrative that digital assets benefit from the same growth drivers as high-tech and artificial intelligence stocks. When that narrative faltered, crypto downside became steeper. 3. Shifting monetary policy expectations. Although not the sole cause, evolving expectations around interest rates have played a role. Investors wary of higher-for-longer interest rates have been less inclined to hold riskier assets like cryptocurrencies. In similar downturns, such uncertainty tends to reduce speculative allocations. Bear market signals. Analysts sound the alarm historical bear market patterns. Strategists including Barry Bannister have drawn parallels to previous crypto cycles, warning that Bitcoin could test significantly lower support levels if historical trends repeat, potentially dipping as low as around $38,000 on a full market correction. Investor sentiment weakens. Notable voices in finance have expressed skepticism about a near-term rebound. For instance, investor Michael Burry, known for predicting housing market weakness during the 2008 crisis, has stated there's little fundamental reason for Bitcoin's decline to stall. Divergences within the crypto market. Despite the broad sell-off, spot ETF flows tell a complex story. Data from ETF markets show spot Bitcoin ETFs experiencing outflows, in contrast with XRP and Ether ETFs attracting some inflows. This suggests some diversification in institutional strategies, even as Bitcoin's narrative cools, and could indicate contrasting views on longer-term support for other digital assets. Technical stress on altcoins. Other industry sources noted that tokens such as XRP experienced steep technical breakdowns, reaching multi-month lows and signaling intensified bearish momentum across the broader altcoin market. Broader context. Is this a crypto winter? Many analysts and market observers have used the term crypto winter to describe this extended period of downward pressure and reduced volatility in digital asset prices. With Bitcoin and major altcoins losing significant ground from their highs, the narrative has shifted from rapid appreciation to consolidation and cautious market positioning. Key contributing factors. Exhaustion of last year's rally narrative. Heavy rotation into safer assets. Technicals signaling extended drawdowns. Persistent macroeconomic uncertainty. What investors are watching next. Market participants are now focused on several pivotal elements that could shape the coming months. Monetary policy signals. Any shifts in Federal Reserve or global central bank policy, especially hints at rate cuts, could influence speculative asset flows. Regulatory developments. Legal and regulatory clarity for cryptocurrencies remains a major driver. Delays or uncertainty around legal frameworks, especially in major markets like the US, could continue to pressure prices. Sentiment and liquidity. Crypto markets remain highly sentiment-driven. Any resurgence of bullish momentum, triggered by renewed institutional interest or technical support levels, could spark relief rallies. In summary, the February 2026 downturn marked one of the most pronounced corrections in recent memory, with Bitcoin and other major cryptocurrencies sliding sharply amid market rotation, weak sentiment, and broader risk-off dynamics. While some segments like Ether and XRP ETFs have seen inflows, the prevailing trend reflects caution and a possible prolonged period of subdued crypto price action.